Strong third quarter as investors go wild. How will this change our portfolios going into the fourth quarter? Stay tuned. We'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV. First up, don't forget, click show more for additional information and links to today's video. Also, if you're looking for a different opinion, that of Wall Street or Big TV, please do consider subscribing. First up, let's go to the big chart. Before we get started, don't forget we've created a bunch of videos on some of these terms, RSI, moving averages, etc. We'll have links below, and I'm sure that Michelle is going to put something up top. Also, starting out with our monthly view, as you see, very bullish, right? Going straight up there. Is there anything I see that I don't like? Well, you know, I always go a little bit deeper. At the top, relative strength, and you can see it there. We're having a divergence here at the top because when we hit all-time highs, we had a lot of strength. We hit it again, but not so much strength. So that's what we call a negative divergence. But despite that, long-term view is still very positive. How about that midterm weekly view? You can see it there. What a great wedge going straight up. Anything here I see? Well, same thing at the top. Negative divergence on relative strength. I'll have Michelle zoom in a little bit there. The other thing is pretty obvious. You see that wedge? Something has to happen there. We're either going to break out or go the other direction. So, to be determined, midterm view, obviously very positive right now. How about that short-term view? Let's take a look at the daily charts. Same thing, obviously we see everything moving up strongly. At the bottom of the chart there, we have the VIX. Not a lot of volatility this year. Pretty much in the 12 range all year, which is fairly complacent. Next up, momentum on the chart there. As you'll see, and it zooms in, we'll have a little bit of a negative crossover over the short term. We'll see if it lasts today. We'll have a strong open after the NAFTA agreement or the new NAFTA or whatever acronym they came up with on that one. So overall, short-term view looks pretty good, but of course we're going to go a little bit further. And I've been showing this chart now for a few videos. This is the S&P in black, and you can see it hit all-time highs at the beginning of the year. I'll have Michelle show the first part, excuse me. And you see new highs minus new lows. That's the gray histogram. Strong in January because you had more new highs, right? Companies hitting new highs versus new lows. And then you continue out that chart, and we're continuing to hit new highs without the strength of the market behind. Look at the new highs minus new lows, series of lower highs, and then going negative last week. Don't love that. So, long-term positive, midterm positive, short-term is still positive, but what does it all mean to you for our clients or investors? If we're invested, we are fully invested right now. If new monies have come over, I'm working my way in the market. I'm not rushing in to all-time highs without a lot of conviction. So hopefully we'll be deployed by the end of the quarter, but to be determined. Next up, NASDAQ. Obviously it's continued to go up. It's really been the strength of the overall markets, but we've had a little pullback, a little bit of a consolidation. At the bottom of the chart, momentum looks ready to break out, to be determined. How about the Dow? Just 30 stocks, but always good to take a look at. Hit all-time highs back in January, came down. A little bit weakness there, more weakness than the S&P, but then we started coming up again. Break through there on that red line, right? That's called resistance. So we break through, looks good, but then it failed. And it came underneath that. So we'll see what happens. Can they get above that all-time high again? That'll be a big determining factor on where we are in the overall markets. U.S. equities as a whole, 11 of 11 in an uptrend, although with not a lot of strength. which is the same as 2 weeks ago. International, 13 of 53 sectors that we do follow, but as a group, I would consider them to be down. Next up, tweets of the week. First up, Jesse Felder. Really good follow. We have a link below to this tweet and you can follow him as well. But what he's showing here, 76% of companies, 74 of 98 as of last week, have reported negative earnings per share. And you can see the chart, it's been strong and a breakout. So that does not bode well going into this quarter as earnings really starts next week. Next up, Lance Roberts. Another great follow, been following him for quite some time. The mother of all speculative bubbles. Woo! There we go. Check out this article, very interesting indeed. The last one is just kind of a little disagreement I got on Twitter last week. Had this advisor put something out about the theory of buy and hold and stay the course no matter the circumstance. And I saw it and some other folks that I follow commented on it. And I agree with them that you don't always have to be in the market. Just like you don't always have to be in international. We haven't been since the second quarter with emerging markets and international as a whole heading into the third quarter. So, you know, the philosophy of this individual was just rebalance to manage your risk. I'm sorry, I don't agree with that. Link below for the full tweet. It got ugly. But it was fun also. Next up, what keeps me up at night? Okay, here's a look at the Fed chart. And as you'll see at the end there, the big push to rise rates. Pretty quickly, right? We haven't seen this type of push in quite some time. Why? Because the Fed is going to need ammunition as we head into the next recession. Most people are saying late 2019, 2020, and the Fed is not going to have ammunition. So they're trying to get there as quickly as possible. Last week there was talk about the new chairman. Was he being accommodative because he took it out in his speech, the written part, but talked about it. So when he said we will be accommodative if possible, but in order to be accommodative, they need some more power. They need some more arrows there to be able to hit the next recession, to be determined. How about earnings? You know, everyone's talked about earnings. I saw another big guy on Twitter this morning. Can we disagree? It's just been good earnings, which is driving this market. You know, I don't disagree that we're up, but if you look at this chart here, the red line shows the S&P. The blue is GAAP earnings, generally accepted accounting principles. Earnings, true earnings, not non-GAAP, which is, well, goofy, do this, this, and this to make your earnings look good. But there's a couple parts of the chart. At the bottom, you'll see GAAP earnings growth through last quarter, 8.95% from 15 to the end of the quarter. But the S&P's up 41%. Now, remember, when you buy a stock, when you buy a sector, you're buying based on earnings, future earnings. So here, when you look at it, earnings have only grown 8 and change, but the S&P has been over 40%. I think that is really stretched. My own personal opinion, of course. Next up, gotta love Hedgeye, some of the best, not only commentary out there, have a link to him, but a good image here as well, the good, the bad, and the ugly. Obviously seeing a lot of bit of issues across the world, and this particular chart will show, yes, US on the other side is strong, and you see all those other countries, not so much. So, you know, in order for this to be a true bull market around the world, we all got to be participating, and it's just not happening right now. Hey, don't forget, for our Wealth and Wisdom viewers, we have a new financial plan just for you. We have a link below. If interested, check it out. Check it out and let us know. Next up, treasuries and currencies. So treasury yields, I've been talking about this. Yield spreads, which is a 10-year treasury minus a 2-year. Now clearly, as you look, the rates have gone straight up here. Okay, when you see a yield spread, it's when the lower, the shorter term, 2-year in this case, goes up quicker, and we're obviously seeing that, and our yield spread is down 0.24%. Pretty weak. Now, when it inverts, I know I say this every week or every other week, that is not good. It's usually a precursor to a recession, and this chart will show it. Okay, when you look at it each time, when we have the yield invert, the S&P's at the bottom, we generally will hit into a recession. The inversion point is that green, 0, and that's generally where we'll see that recession. So continue to watch this very closely. Next up on my radar. So 2 weeks ago, we talked about semiconductors. They were setting up, did add it to a couple of portfolios, broke out a little bit, then came back down, and now on Friday had a strong move to the upside. We'll see. Still like this sector, as I think semiconductors in general, buying a new machine for video editing. I mean, it's awesome, some of the stuff that's happening out there. Next up, biotech. I talk about biotech here and there. I keep it in a lot of portfolios, but now it's being added to all our portfolios going into this quarter. You can see there we've had a golden cross where your 50-day goes above the 200-day. Setting up, just broke out to recent new highs with some room to run. Definitely like biotech here as we head into this quarter. We'll see what happens. Wrapping things up, fear and greed. Big move down here. So 2 weeks ago, we were at 73. We're down to a smooth 47, which is neutral. I would agree with that right now. Even though our signals are positive, I'm still being cautious. I have concerns about bonds and the effect on our portfolios. So it is a good time to rebalance, take some profits, get yourself set up as we head into the fourth quarter. As always, thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.